Hello everyone, R2F here with another video. In this video, I'm going to go through seasonal tendencies as per ICT's concepts. Okay, so what are seasonal tendencies and what are they used for? All right, so seasonal tendencies are basically whatever asset you're looking at. In this example, the dollar index is likely to do at different times of the year. All right, so let's say you're planning a holiday and you want to take a trip to whatever country when it's most likely going to be summer, for example. If you're looking for good weather, if you want to go skiing in another country, you would look for when it would be snowing, right? So, whilst the temperature and climate is not 100% the same every year, there's a high probability and high likelihood that, for example, you'll get the weather that you want. So that's a seasonal tendency, and a seasonal tendency in the chart is basically different times of the year where it has more bullish or bearish movement. So I'm going to open the seasonal tendency chart for the US dollar, and this is it. This chart is taken from More Research Center. It goes all the way up to 2018, but it takes data from 33 years ago from that time and 15 years ago. So you'll have 2 points, two plots on the chart, blue and red being 15 years and blue being 33 years of data, average data on the chart. Why two different data points? So that you can kind of compare one for a shorter time span and one for a longer time span. On the bottom axis, you have the months of the year, and on the vertical axis, you have 0 to 100, which is it's basically an oscillator showing that 100 is the strongest when the dollar has the most bullish price action in the year, and 0 being when it has the most bearish, and of course everything in between. So January to February, there's not too much that you can use in there because of this consolidation type of price action. Nothing's very clear. But as you get into March, we see some bullish movement on the dollar, and then a decline into April, and April being a large drop into May. And usually in May, the dollar gains some strength and starts, I guess you could call it consolidating. And then the lowest point being in near the end of September and somewhere in the middle of October. Another bounce on the dollar, and then you get more consolidation. So the key points in this type of chart are the two extremes and the largest volatility. Basically, that's the type of data you want to have a look at, and also where two data points kind of melt together. Okay, so if you see March into April, we see a high. This is a good time to observe the charts going into April, and May is also a good time to go in the charts um, as well. So, if you were based on your analysis, besides the seasonal tendencies, and you see you're expecting bearish price action on the dollar, and you see the seasonal tendency is likely to have bearish dollar as well. This is a confluence to your analysis, right? So you do your analysis first based on whatever you use, technical analysis, for example, ICT's concepts, and then you go into this um, chart to seasonal tendency chart to add confluence to your bias, right? So you do not want to use this with the expectation the dollar is going to go up if it's not showing on your original analysis. So let's go on the chart, trading view chart, and see what that looks like. Okay, let's have a look at May to June, which from here is the bottom coming into June, right? So we see bullish price action on the dollar historically. All right, this is just historically. It adds probability. It's not something that will happen. And we see here from May, starting of May, we get a spike up and some price action coming down, not taking out this low, building up liquidity for you ICT people. And we see an expansion coming into a premium area, uh, order block over here, and a fair value gap as well, before price starts to move lower into a different target, these equal lows, etc. So how could you use this? Depending what your strategy is. For example, we have a break of structure here, um, on the retracement to this, I guess, order block, mitigation block. You could take a trade there, or there could be something on a lower time frame that could tip you off as well. Or if you use fair value gaps on this time frame, there isn't any. But basically, if your analysis shows that you're expecting a draw on liquidity to the upside, and the seasonal tendency shows uh, bullish movement for the dollar, that adds confluence to your trade. That makes it more high probability and allows you to win more trades. So let's have a look at the euro dollar, because unless you're trading dollar futures, you can't trade a DXY. So let's see the euro dollar. So we see on the euro dollar, we should see a decline, which we do, as the euro dollar is most of the dollar basket. From here, 1st of May, we see a spike up. We do not take out that high, and then we drop, creating somewhat of a double top all the way into June, where we start to retrace and we get more bullish price action on the euro to take out liquidity above these highs, and into, I'm sure, an imbalance on a higher time frame as well. Okay. So yeah, it's really that simple. Basically, you can have a look at the chart. If you're expecting, bearish euro dollar, you'll want to see strength on the DXY chart. There's also the euro index as well, and different indexes, but indices. But I prefer to use the dollar index and base my analysis off of that to reinforce what I'm expecting on, dollar pairs, for example. Okay, so you're not going to see it every year. For example, if you even go to this year, let me plot out from the 1st of May. This is the euro dollar, yeah? 1st of May to 1st of June. It's around here. The dollar should be getting stronger, but you see the euro dollar starting to expand up. So always do your analysis first on the chart and not the other way around. If there's a higher time frame PD array on, on the asset that you're watching, it may be stronger than the seasonal tendency. And as we know, seasonal tendencies can be used for manipulation as well, because people are more likely to be bullish during certain times, because of certain economic factors and other fundamental factors. But the higher time frame analysis on your chart should always be considered first, and then your lower time frame, and then of course using the seasonal tendencies to back up your trade. So you can see what would happen if you're coming into May and you are trying to short the euro because it came into here. But if you go to a higher time frame, there is, okay, if you go to the monthly, there's not too much on here because we're in a consolidation. But if you go in things like, let's say, the pound, there's also a monthly gap that it came into, and you can see how it is respecting it and quite possibly likely to move higher based on what we see here on the chart. New fair value gaps being created, bullish price action, bearish fair value gaps being disrespected, and more draws on liquidity, such as this volume imbalance. All right, this could be a nice target as well, coming. Oh, what's wrong with this? Coming into this area here. Came into there once, but this is too short of a time span. Coming to you again, we could target that besides these highs here as a target. Okay, so that's it for this video. I hope you found it insightful, and I hope it helps you create more high probability trades. Remember, trading is about taking high probability trades. It's not about just trying to make money in every situation. You want to wait for a good time and capitalize on that and grow your account through consistency and making profit in the long run, having a longer term mindset rather than a shorter term mindset. So till next time, R2F signing out, and safe and happy trading.